If I'm selling a home, I like to sell it on a lease with an option to buy because then I still am on title. It's an eviction versus a foreclosure. I can continue to depreciate the asset, and then I can 1031 exchange it where I can't do that on a contract for deed because it's technically an installment sale. So if I'm
Interesting.
buying, I want to
Yeah.
buy on seller finance. If I'm selling, I want to sell on a lease with an option to buy, just from tax, rent, and more favorable terms, just as me as an investor versus a buyer. And so depending on whoever's listening, like flip-flopping that, like, and then contract for deeds kind of in the middle.
If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities so you can take your commissions and turn them into cash flow. Here's your host, Randal. Let's dive in.
Hey, welcome back. Today's guest, Adam Zock. This guy, he's got so much going on and he talks quickly. And so the conversation is awesome. Like, I really enjoy chatting with him and hearing how he's built his business and what he's working on. So Adam is the owner of Home Equity Partner. They have, he tells me what he's working on now. He's actually building a platform to pair rent-to-own buyers with properties and with investors who are buying those properties. So it's a very cool platform that he's creating now, and how he got the money to actually start this, he talks about. And so I won't spoil that. But the conversation, again, we talk about how he's ramped up and how he is paying full retail for properties and still making a lot of cash flow on a per deal basis. He's done over 400 of these deals, rent-to-owns, and so, yeah, we just break down. You're going to get something out of the show. If you're curious on how to structure this type of deal, or if you're a real estate agent and you're looking to maybe make some money on some rent-to-own buyers that you aren't sure exactly how they are going to qualify for a property, or maybe their lender didn't qualify them, Adam has a program where he's paying $1,000 per every person that you bring to him, plus paying a commission if you're out there finding the house for them. So very cool program. Again, he's got all kinds of stuff going on, and I enjoyed the conversation. Hope you do as well. If you're getting some of that show, please go on, rate and review, helps us a ton. On our front, again, I just want to remind, we have the RamCap fund going on right now. We're raising capital. We're raising $5 million. We're buying single family properties in the Texas market. We're fixing them up, and then we're owner financing those properties. That spread allows us to be able to pay you, the investor coming into the deal, 10% or up to 10% as a preferred return. So jump on ridgelineig.com, go to the offerings tab. You can check it out right there and see what we're working on and jump into that fund. So without further ado, let's jump in. Adam Zock, here we go. Adam, welcome to the show. It's good to have you on, man. I'm looking forward to this conversation. We were just talking a little bit just now about the different structures that you have and the different types of investment activities that you're working on. So why don't you break it down and let's talk about, you were saying you're buying stuff off the MLS, and then you have multiple exit strategies, and you have a business that's set up specifically to target rent-to-own buyers on the back end so that you have a pool of buyers ready to go for anything that you buy. So let's just break it down and kind of explain it to the audience so that we understand your business and what you're working on.
Sure. Yeah. It all starts with the people that are actually going to be living in the home that want to move in on a rental agreement with the option to buy. So Home Partners of America, Divvy Homes, Zero Down, they're doing tens of thousands of these homes in the major cities. So it's nothing groundbreaking, but it's just very different. Like, it's normal. Like, you go to Zillow and it's for rent or for sale. There's not like a rent to own option like on Zillow. So it's not as mainstream, but there's 50,000 people searching rent to own homes near me every month into Google. And so all we're doing is solving that pain point. And so there's some people that are like, I have no credit and no down payment. Give me a rent to own home. I'm like, you shouldn't even be in a rental. Like, I'm not going to approve you just to move into my normal rental.
Yeah.
However, what we're sifting through then is that rare people that's like, hey, I'm like this close to a mortgage. I can put down 5, 10, 20%. I might even have a 700 credit score. And like, for some reason, my DTI doesn't quite work out, or I'm self-employed. So they want to see my 2024 taxes, but hey, I want this house now. And I want to lock in a rent price and a 4% appreciation per year price. Like, if you can do that for me, like, great. And I was like, awesome. Let's do that all day, every day. So you're telling me that I can buy the house. You're going to move in day one. So I'm going to have no vacancy. You're going to take care of the home, and then you're going to buy back the home, from me. And it's like, that sounds pretty cool. So that's essentially what we started the model around. So that's what we do all day, every day. Is like our company, Home Equity Partners, we're just sifting through and tapping into that market. And then we're giving them the equivalent of what's like a rent to own pre-approval letter. So
Yeah.
similar to the investor going to the bank, getting their pre-approval letter, like we're issuing them like, hey, go pick out a home in San Antonio, Texas. That's for $400,000. And because the property taxes are high in Texas, your rent for a $400,000 house is $5,000 a month. Will that work for you? And if they're like, no, I'm like, okay, well, I can't make any money on that because my PITI is $4,000 a month. And so for me to make anything, on this, it's got to be this. And so they say no, they say yes. We're just like, hey, we're just another option. You can wait for a bank, or you can go rent a house for $3,000 a month. But then 2, 3, 4 years down the road, you got to be in the same spot where you got to either move, houses may have appreciated and different things. So what we found out is that if I can just get 4% per year for me or for the investors that we assign these to, like that's good for me. And if the home happens to appreciate by 10%, good for the tenant buyer. Like that's all I want is cash flow and a 4% appreciation per month. And I'm willing to sacrifice a little bit on the upside by just protecting on the downside and getting the cash flow. So what it looks like is we essentially get the homes under contract, and then we'll either A, close on them ourselves, B, assign them to an individual who's like, hey, I just want a cash flowing deal. Or 3, we started a syndication where we're like, hey, we're raising $400,000 every quarter, and we're going to buy 6 homes every quarter. And we have this pool, and then we do a quarterly raise versus what would normally go on in the syndication, which is normally like, hey, raise 3 million. It's a value add. And then you're going to kind of get the money on the exit. It's literally we set up the syndication, which is really strange, or a different way of doing it on the single family front, where we're going to a lender and be like, hey, we're going to buy $5 million in real estate. And I don't know what city or state they're in, but it's going to crush the 1.3 debt service coverage ratio, because that's the only way that we're buying a house, which makes the banks, somewhat happy. That still has to appraise out. We're still doing a home inspection. We're still making sure that it generally passes FHA guidelines, because you got to get a rental certificate. But that's kind of the whole premise, is just buying a home as a normal investment property with a normal rental. It's just this added option agreement, which they have an option fee down payment ranging from 2% to 20%, and then giving them the option to buy it and a little bit of equity that they're building every month.
Okay, so first things first, you're finding these houses. You're buying in multiple states, correct?
Yeah, and it's you have 2 different ways of doing it. You can have the asset and fill it with what I call a tenant buyer or a rent to own tenant, or you can find the person first and they go pick the tenant. So we have 0 homes. We just have the tenant go pick an agent of their choice, which is why agents usually like us, is because they're like, oh, my buyer can't get pre-approved. We go, cool, send them to us, and we'll at least give them an option. Are we more expensive than a bank? Yep. But if someone's motivated, send to us, we'll pre-approve them. And then now I'm actually your buyer agent, or you're now my buyer's agent, and you still get your 3% on the closing. And so then we're actually pre-approving people first, and then they go with the agent. They just pick a house that's within their rent to own pre-approval terms.
Okay. All right. Let's break it down house, and then we're going to talk about the borrower, the rent to own buyer. So the houses themselves, let's say easy numbers. You find a house, it's $100,000 retail sale, right? That's what it's worth. Easy numbers. Are you guys paying full retail?
Yep. So we'll offer what the tenant wants to offer. If they want to offer 125,000, we'll be like, all right, you got to come up with the extra 25,000, but they're essentially naming their price just like you would with a bank. And the only caveat is it's got to appraise out. And if it doesn't, there's either an appraisal gap or something. We've had some investors get a little bit savvy and be like, all right, I'm going to come in all cash, buy it for 90K and kind of hope for an equity margin spread. But in general, it's paying pretty close to list price or whatever the offer price is that the tenant is driving it, which is why we like to give them control versus us. Although we're signing the purchase and sale agreement, or the end investor is, and so they have final call, we like to give as much power to the tenant where they get to actually name their price. And if the buyer doesn't, or the seller doesn't want to accept it, that's fine, but we give them more power.
Okay. So you guys are getting it under contract, and the ones that you may close and you actually own those things, you turn around and you're rent to own that with an end buyer. Sounded like you said you are then selling that to another investor. So you guys are exiting completely and you're just wiping your hands and you're done. Or is that what's happening?
Yeah, it's either like we'll literally close and take title, and then we have a rental agreement with this individual. We'll assign it to, call it a doctor in California. Him or his LLC will take title. He has, the rental agreement, or we'll assign it. And so we don't close on it and then sell the home. It's literally assigning the contract to this outside investor. Right. Or what we have is our syndication fund, which is like, hey, we can take 6 deals a month.
Okay. So I guess explain the numbers to me then. Again, $100,000 house, it's full retail value, ARV, whatever you want to call it, is $100,000.
Yep.
You guys are buying it for $100,000. Where are you getting an assignment fee in there
Mm,
How
sure.
are you so somebody's paying over retail essentially for this house. Is that
Sure.
what?
So on the smaller price homes, the numbers don't work out as good. So I'll play with
Well,
it
a
first.
four
So if
hundred
it's a
thousand
hundred,
dollar
if
house. Yeah.
sure. So if it's a $400,000 house and we're taking a 10 to 15 grand assignment fee, that's roughly, 3 or 4% of it. The tenant's coming in somewhere between 2 and 20%. And so to negate our 3%, let's say the tenant came in with 3 and we came in with 3, you're basically break even where you're paying exactly $400,000 for it. If the tenant buyer's fee is higher than ours, then you kind of have you're buying it at a 98, 97, 95, 90, whatever LTV, but you're not really getting your wealth on the buy. And so
Sure.
then you're selling it at a 4% to 5% appreciation per year. So you're buying it at 400, selling it at 416, 432, 452, for each subsequent year to the end buyer. So your spread is when they exercise their option.
Got it. I got it. Okay. Again, say it's a $400,000 house. The
Yep.
tenant buyer is going to give you, call it $15,000. Is that not
Sure.
getting credited to their purchase if
So
you are
it's
selling it?
Yeah, no, it still is. So let's say
Yeah.
you're buying it for 400, you're selling it to them for, call it 414. Yes, their balance to you after 1 year is $400,000 because they
Okay.
already gave you 15. You have that initial spread. And if it's negating our, call it our 15 grand, you're basically your profit on that deal will be roughly 15K.
Yeah. Yeah. Got it. Okay.
Just like if you literally bought it and sold it the next day.
Yeah. Yeah. So what I guess the missing link there was the actual, the resale is based on the appreciation amount. And so what are you giving? You're giving them 5 years to execute the option, 2 years.
Well, yeah, most of them it's 3 years. You can go up to 5, but yeah, for most of the part, it's 3 years, and then you
Okay.
give them the option to extend. And the reason for that is when us or investors are typically buying it, it's on a commercial loan, not in their personal name, so it's a 5-year fixed, 20 or 25-year AM. So the 5-year fixed term at whether it's 4, 5, 6, 7, or 8%. I know that I'm not owning that house after 5 years.
Yep.
No matter what, they're either buying it or I'm liquidating it within 5 years.
Yeah. All right. I got you. Okay. So you're talking about that. All right. And then you have investors. So you're doing this. It's a great model because then you could pay a lot more than any other investor that's out there trying to buy a property and you're not competing with. Yeah. So are you guys doing rehab on these things, or is it basically you can buy things that don't need rehab and it's really just a
Nope. Prefer non-rehab. So our sweet spot's probably between 200 and 600,000 from North Dakota to Texas to probably over to Florida and up to New York, where the price to rent ratio makes sense. I can't make the numbers work in California because it's like $600,000 house rents for $3,000 a month. I was like, you're just hoping for appreciation versus the same $600,000 house in Texas. We get $7,300 a month in rent from it. And I was like, okay, well, that actually cash flows.
Yeah. Yeah. Awesome. Okay. So that you guys are making the market on the back end because the borrowers. And so, all right. So that's the house on the buyers. Like, how are you guys going about qualifying them? How are you making sure that they can make that additional rent bump if it's a $4,000 mortgage payment and they're now paying $5,000? How are you guys qualifying them?
Sure. So I passed the MLO last year just to understand this a little bit better. So we screen them almost like a loan originator and a rental. So I mean, we're doing full credit, verify income, calling past landlords, doing the criminal, the collection, all of this, where we get to see their full profile. And having done, I think 450 some of these, you start to see some patterns on what's going on. But in general, it's like if they have a high credit score, it's a lower down payment. If they have a lower credit score, it's a higher down payment. It's almost just like a seesaw, and there's nothing super groundbreaking from it. But me as an investor, I'm just like, oh, this person's riskier. What reduces my risk? 20% down from a tenant, which is basically like prepaying 2.5 years of rent. And I was like, there's almost no way I can lose money on that. If someone moves in 6 months, 3 months, 7 months down the road, I mean, they would like literally have to like trash the place, stop paying rent. Cause I mean, you can evict it because this is a lease with an option to buy, which is different than a land contract or seller financing, which is a foreclosure, which we learned out because we were doing contract for deeds. Then we're like, oh, it turns out if they default, I got to foreclose. And in North Dakota, that's like a 9-month process. And I was like, that can really hurt you. But on a normal eviction where it's like 45 days or 60 days, and then on top of that, we make the tenants pay for rent guarantee insurance, which is like the equivalent of private mortgage insurance. And there's 3 main companies like the guarantors, Leap Easy, and then I think Single Keys trying to break into it. But it's like maybe 2 or 3 months of coverage of basically lost rent that they'll cover. And each one has a little bit of a different policy, but it's kind of like if the biggest risk is they default, I want 2 or 3 months of consistent cash flow until I liquidate the asset. And people have either liquidated it or sometimes they'll find a new renter. Our version is we usually just liquidate it because like, hey, I got a $600,000 house. Average rent is $5,000. They were paying $7,300. They dropped in, 35 grand. And really the intent is, hey, I want to, you can keep it. It can still, either cash flow neutral or something, but like we typically buy the asset for a purpose. And if it doesn't work, that's different, which is different than some other strategies that I have is like, oh, I'll just buy a property in Tampa Bay, Florida, buy it for 30 years, do nothing with it. Just, appreciation, debt pay down, and cash flow. It's like, oh, that's one strategy. We've just found that this rent to own strategy, it's like, I just wanted to maximize my ROI. I want the least amount of capital in. And when they're most of our clients are bringing 10% down. The average, I think, is like 12.5, which really helps negate if you're coming in with 20 or 25% down. Like now your cash down is less. Your cash flow is typically higher than a normal rental. So like the cash on cash ROI is like that we're going to take on a deal, is 20 to 30%. And before Brennan Turner told me that 8% or 12% is like what I needed. And I was like, I still can't find any deals like to this date, if I was just buying a property off the MLS that actually cash flows. So this was just our way of generating our own cash flowing deals. And that's really what I cared about. There's still, team wealth versus team cash flow. And I think both are important. But for me, cash flow is what freed up my time over wealth.
Yeah. For sure. And having that consistent cash flow coming in, put your mind at ease quite a bit as well. So you can focus on other things and actually grow business while you're working.
For sure. And that reoccurring revenue. Yep.
Yeah, for sure. So how many do you keep and how many are you, I guess, selling off? Like of the 400 plus deals you've done, like what are you trying to do with your portfolio?
Sure. So I would say we probably own half of the overall deals that we've done. And moving forward, it's probably like a third. A third of them we're keeping, a third of them we're sending to individuals, and a third of them are going into the fund. We played around with the fund idea because this was a little bit new. Our investors like, hey, like I don't really want to do this. Like they didn't want to, own the property, find a property manager. And sometimes we can be asset managers for them. They're like, hey, what if I was just truly passive? Like, well, that's kind of a little bit different. That's some security stuff. And, what can we do? So we actually did a 506B as an unsecured line of credit, just like a promissory note, no mortgage. So that was, 506B number one, where people are literally just loaning our company money. And I was like, great, I can give someone 10% just as working capital and I can go out and buy assets. And it's like, okay, that's one version of doing it. But I was like, that's not as great of a sell to investors. I was like, hey, what if we do the normal syndication model where it's like a 10% preferred, 70-30 split? We'll raise all the capital, do all that. We'll get, some split for the profit, but we don't really need to bring capital, even though that we co-invest on all of our deals because I think it's the best cash flowing deal that I can. So like I'm personally investing into all of our individual funds that we're creating as well as in addition to being a general partner. And so it was just like, oh, how can we do that? And it's like, okay, great. Now they get all the LLC benefits of depreciation, a write-off. They're getting diversified across 20 single family homes across 10 different states. And so then assuming that we can still package that together, find the deals, then it's just aligning the capital with the deal flow.
So are you raising in advance? So it's kind of like a blind pool and then you deploy the capital, or how are you structured on that front?
Yeah, it's so let's say we're going to do like a $5 million raise, which is like, all right, we're going to raise $400,000 every quarter. And so it's like, oh, so yeah, basically raise 400 grand, like, cool. Now here's our deal with pipelines, use up that capital. If we've used it up super fast, it's like, okay, well, we got to wait till the next quarter. And that's where we kind of keep some or assign some to some others. If deal flow was slow, maybe the next raise is only 100 grand or 200 grand to kind of align with the deal flow, which is tricky when you're doing like deal performance and whatnot. But like right now, capital raising is not, really an issue for us because it's like, okay, well, we're doing it at least for our, past ones. It was like, oh, a 10% preferred return with a 70-30 split. Cause I was like, we're one of the only syndications that can hit cash flow, like literally, day one, because we're just buying the asset versus like a value add, which, in some ways can have a higher equity multiple, but for us, it's for me, it was like designing it more around cash flow. And so that's kind of how the deal structure goes, and it kind of ebbs and flows a little bit.
Yeah. So then when you exit the syndication, you are assuming they're either going to refinance those borrowers. Yeah.
Yep.
Or you're going to wholesale it at that time, or what are you going to do to exit?
Yeah, so it's either they buy or we liquidate the asset. And so we're like in our underlying portfolio, we're like, oh, well, let's just assume 50% of them buy and 50% of them don't. And of the 50% that buy, it's like, okay, great. That it meets basically pro forma exactly how we wrote it. Of the 50% that don't buy, there's probably more of a stock market volatility where it's like, oh, some of them we lose money, but then some of them we actually make a bunch because like, oh, I bought a home 2 years ago and now the home was 400 and now it's actually worth 450 plus I had 40 grand from them. So it's like, oh, we actually made more money on them not exercising the option, but that's not the intent. But then you can have some where it's like, oh, we bought it for 400. It's still only worth 400. Then we list it with a real estate agent, by the time you pay, 8% or something like that, it kind of takes away that 40 grand that they were initially contributing. So it's like, oh, that's maybe more of a heads I win, tails I break even type mentality.
Yeah. Yeah. Okay. Interesting. So I have you guys closed any of those funds, or is it you have one syndication that is set up? And it sounds more like a fund than a syndication because you're buying a bunch of different assets, right?
Yeah, I guess I don't know if I've looked into the difference between a fund and a syndication. I typically interchange them, so maybe I need to be educated on the correct way of doing it.
Syndication typically is one asset, so you're going out so that's why I was like, how are you syndicating single family houses? That's why I kept going back to that. But yeah, you have a fund.
Sure.
You're raising the capital and you're deploying that capital into multiple different assets.
You got it.
And so you set up one. It's a $5 million total fund. Yes.
Yep.
Okay.
Got
and
it.
then you have multiple closes, is what it sounds like. So you're closing every quarter. You're doing a close.
Yep. So yeah. So the goal is for the main holding company is one home under contract per week, and so we're pretty close. We're batting about 80% this week. We typically do more deal flow on quarter 3 and quarter 4, but in general, yeah, it's like, hey, if we can close on a deal a week, that's a pretty good year for us.
Yeah. And so the majority of the business driver has to be your borrower lead generation. Is that correct?
Yep.
Yeah. So, I mean, you could buy, if you're buying off the MLS, paying full retail, you could basically buy anytime, at any time you want.
Yep. And so there's a couple tricky parts where it's like, okay, it ebbs and flows between capital and deal flow. Cause it's like, oh, we got all these homes under contract. And even if they're putting 10% down, if I'm buying 9 homes, at 50 grand a pop, it's like, okay, all of a sudden that's, $500,000 of cash.
Yeah.
And it's like, okay, well, assuming that we have a syndication, it's relatively easy to, kind of ebb and flow and make that work. But what gets really tricky is the debt financing.
Yeah.
Because it's like, oh, you're buying these all over the place. And so it's like, oh, well, who's going to lend to you? Because it's not Fannie Mae, it's not Freddie Mac. It's like, oh, we got to find a local bank or a community bank that's like, hey, this is what we're doing. Get the general partnership to be strong enough on paper that they pretty much just give us like a $3 million guidance line. Like, all right, assuming that it meets a 75% LTV on a 20-year AM and it meets the 1.25 debt service coverage ratio, you're generally good to go with that. But that's harder to find than anything else. Because if it's just a single asset, it's like, oh, it's under contract, let's underwrite it, here's the deal, and away we go. But it's like, hey, we want to buy homes across 25 states, and I'm not going to tell you which city or state or condition yet, and I just want a blanket $3 million guidance line to go buy homes, over the next 6 months.
So how are you guys handling that? Like, do you have that guidance line set up?
Yep. So we have a couple of banks that have it set up that work really well, and so now it's just like, okay, how do we continue to do that? And it's usually just bring in probably the equivalent of a key principal to what the multifamily guys do. We're just like, all right, this guy's got 5 million sitting in the bank, and if he's willing to personally guarantee it, we just give up part of our general partnership stake to this individual who's willing to personally guarantee it. Because now the bank's like, okay, I feel pretty good. I'm at a 75% LTV. I got assignment of rents, and then I have this personal guarantee from this whale, and in addition to a mortgage on the asset.
So you have that set up, and that is actually running.
Yeah, so that's what we did on our first syndication last year. That one got fully funded. We bought all the homes. Now it's just in performance mode, and so we're hitting pro forma there. And now this next fund launches. It's May now, so we're going to be starting the very first capital raise on this next one in probably the next 30 days.
Awesome. Yeah, awesome. And so the first one is just going to run. How many assets do you guys buy in that first one?
In the first one, we started off because it was like a proof of concept in that fund. It was like, let's start off small. Let's do like $1 million raise. Like, hey, does this work? Is the bank going to work? Can we actually match the deals with it? And so it took us about 6 months, and we bought, I think, 15 homes.
15. Yeah. With $1 million, did you raise $1 million?
Yep.
Yeah. Awesome, man. Congrats. That's a very cool concept. It's, yeah, we have a crowd fund that we did the same, very similar with. And you can set it up, and you can take on unlimited number of investors. And it's you can market, you can do everything. So are you doing a 506B?
Yep, that's what we're doing on both of these. I had looked at the crowdfunding and I was always curious on how easy or hard that is to set up and if it's still kind of an equity dilution or if you guys are doing it as debt structure or how you're doing it.
It's a debt structure almost. It's an income fund. So it's a
Sure.
straight flat return, quarterly distribution up to 10%, depends on how much money you invest. But you can have so many investors in it that it doesn't matter how small the minimum investment is, but you're capped at $5 million. So the total raise is $5 million and then you have to close it down. But we set it up and structured it in a way where we could do what you're doing, which is have multiple successive closes. So we find a house, we say, we need $150,000 for this house. We can go raise 150. They put it in, we could do a closing and draw the money down. So that's one way to do it. But again, yeah, you've got this set up to where it's almost like just the model in general. Who else do you know that's doing this? Anyone?
So I know some of the bigger companies that are like, hey, I've Home Partners of America got bought out by Blackstone for I think like $6 billion, where they're like, I have a ton of cash. I'm just going to buy properties and it's a rental with an option to buy. And it's really just a glorified, I'm buying in the top 30 cities. But this kind of matchmaking effort in Adam's perfect vision, I'm going to have a rent to own marketplace where you got a bunch of investors ranging from institutional to individuals. And then you got a bunch of what I call tenant buyers on the left side, all various location, credit score, monthly rent payments. They each kind of name their price. And it's like almost like a March Madness bracket where they're meeting in the middle. Or I guess the equivalent of what I've been told is like some version of Tinder where you're like trying to match make with like, instead of mortgage loan originators and bankers, it's like, oh, who's interested in doing the rent to own. And so it's just like getting really, didn't know that that's the space that I would be in. I remember watching like a Chris Crone video. I was like, oh, what is a lease option or creative financing or subject to? And it just happened to be like, I was like, oh, and then I think it was probably because I got hooked on Google Ads pretty early. And it was like, oh man, this is like, people are literally searching rent to own. And if that goes away, we have different marketing channels like Facebook or whatnot. But like, man, it was just like, not that it was easy because Google will take your money, very quickly, very easily if you don't have a good conversion. But like for me, it was just like, oh, that's super cool. Where it's like pay per click. I don't have to do social media. I don't have to do outreach. And it was like a business that was more of so it's real estate plus it's a business. So it's super passive. So like we can have a sales and an operations person. And then Adam gets to focus on more strategy and investors and different things. But it was just like this target market where I was like, because I went through the first 10 properties where various flips that we sucked at. It was various turnkey properties that was like 25% down that cash flow $200 a month. And I was like, man, I can buy like one house every 4 years.
Yeah.
Cause it's like, it just wouldn't go. So it was like, oh, how do I just juice the ROI? And then I hated turnovers because turnovers is like, oh, you lose 1 month of vacancy and it just crushes your entire ROI for the year. And then plus there's like grand or more of turnover costs and having like the property manager. I was like, man, how do I? And so it's just like slowly start chipping away at that. The first idea was college kids go pick a house and you can rent it at the 1% rule just to kind of cash flow. Yeah. And so that was the idea of just renting houses on the open market. And then I was like, well, then they leave. I was like, I don't really want that. I want them to either buy it or do something else with it or have more skin in the game. So then it kind of evolved into this.
Yeah. Yeah. So again, you mentioned about compared to owner finance. So the rationale was really because North Dakota was problematic with foreclosure timelines. Is that the main? Go ahead.
Yeah, if I had to put it into 3 buckets, I call it owner financing, which I guess you could call seller financing. I call it a land. Number 2 is a land contract, or what's called a contract for deed. And then number 3 is rent to own, which is like lease option, lease purchase option. So if I'm buying a home, I want to buy it on seller financing because I am 100% on title and there's just a mortgage. Like that's it. On a contract for deed, it's like a vehicle warranty. Like the actual deed doesn't transfer, but there is paperwork at the county that says, hey, they have an equitable interest in this property. They pay for taxes, insurance, and are responsible for all the repairs. But that is it varies in different states, and you get really creative on a contract for deed. Like you could have them sign a notice of cancellation and like hold that in an attorney's trust, and just so that you can avoid the whole foreclosure process. But that's kind of like a whole loophole. But if you're doing it legit, it's like, okay, you have to give them the redemptive rights of whatever the foreclosure states are. Some are super quick, but like North Dakota wasn't. I was like, oh, I don't like that. So if I'm selling a home, I like to sell it on a lease with an option to buy because then I still am on title. It's an eviction versus a foreclosure. I can continue to depreciate the asset, and then I can 1031 exchange it where I can't do that on a contract for deed because it's technically an installment sale. So if I'm buying, I want to buy on seller finance. If I'm selling, I want to sell on a lease with an option to buy, just from tax, rent, and more favorable terms, just as me as an investor versus a buyer. And so depending on whoever's listening, like flip-flopping that, like, and then contract for deeds kind of in the middle.
Yeah.
Land contract.
Yeah. I've done each of those. Back in the day, like in Texas, I know there was a bunch of rules. I worked for an attorney, and it was like, okay, you can't go over 6 months. You have to rewrite your contract every 6 months. I don't know if that still exists, or if that is something that you guys have to pay attention to or not, or if there's a new regulation. This is like in 2009, like when I started doing these, and I did a number of them, but I would just rewrite the lease every 6 months, which was not ideal. But and then like the owner finance side of it, love the owner finance side of it, because I'm really hands off, completely out of the deal except for the servicing of the note. Contract for deed, the title companies here in Texas have advocated not doing that. So I don't know, do you do some of those? Have you done some?
We completely got out of contract for deeds.
Okay.
Either just from industry or kind of those reasons that we indicated. It's just that, yeah, it's just it is, I guess, from the perspective, maybe not specifically Texas, but from us, it's typically a little bit more clean, where it's like, okay, they have like a clear amortization schedule, an interest rate, a buyback period, a terminology. Whereas at least with an option, it's like, okay, what's their buyback price? Oh, it changes per year. And what's the rent credits? Okay, did they pay or did they not pay? And so it's a little bit more gray than the contract for deed, which is a lot more, I guess concrete from the ones that we've done. I've probably done maybe a dozen contract for deeds, but then now mostly, 60, 70 lease options.
Yeah. So how do you manage all these, man? Like, you've got rent payments coming in left and right. What's your setup and operation look like?
So instead of it being an awesome software, just go find yourself an awesome business partner. So I could probably talk about this all day, but being in 5 different LLCs with like 3 different business partners, like, I'm so fan of a partnership. It's not even crazy. I know Dave Ramsey will say, like, the only sale that doesn't ship is a partnership. And I was like, well, what about marriage, or what about something else? Right. And so it's like, it's tricky. Like, my business partner, he can live and breathe, or he can do that. Like, I get all worked up. If someone doesn't pay rent, I'm like, oh, are we doing eviction? Are we doing that? And like, I can't sleep if someone sends me a text. And he's just like a steady Eddie, like all day. He's like, all right, we're going to self-manage all these because they're rent to own. It's pretty much just payments. And if we have to, evict or someone, it's like, oh, you call the real estate agent that we bought the home for. I'm like, hey, do you want to list this home for us? And by the way, who's a good attorney and who's a good handyman? Yeah. And then, like, that's literally like his one phone call. And then like the real estate attorney takes the rest. And because we don't have to do repairs or different things, we had looked at doing like a hem lane or some sort of virtual, property management. But otherwise, it's just like very simple, like apartments.com, like check on the rent, follow up with tenants, do that once a week. And so, for the syndication, we'll charge different things. But for now, it's like, man, he just does all that, himself. And eventually, as we get bigger, we're bringing in staff that help with like the underwriting or sales or operations a little bit. And so we're bringing that, more so in-house, but just on a macro scale, I don't know that I would be anywhere near where I am today. Like, I feel like I'm a pretty creative and driven person, but it's also like, man, I get shiny ball syndrome, like nobody's business. And it's like, oh, what we should do is this. Oh, what would be cool is if we, just did that and flip houses. And he's like, no, it'd be awesome if we just kept doing the same thing we did for 5 years and then just crush the rent to own space. And it's like, you know what? I kind of need that every now and then. And so if you have, it's different, I feel like, with employees, because like it's maybe a little bit of a different mindset. So I think I've gotten lucky. I've had partnerships where it's like, literally I've been holding the bag on $100,000, like to the bad. And so, but still, it's almost like real estate. Like, I've lost, over 120 grand on a single deal in real estate. But it's like, man, if you just do the reps, you learn a lot more and you just get smarter and smarter. And it's like, if I fear doing real estate or fear getting into partnerships, like, I don't think I'd have, any luck, or I just get stuck doing nothing. And so I'm so far in, like, I'm starting up another business. And the first thing I did is like, ooh, who can I pair with? Like, that was like my first question before, like, the idea, before the execution. Cause it's like, it's not built well for me on a lifestyle design to just be like the sole owner. And some people want the control. Some people want to go fast and have the flexibility. And sometimes I want that, where it's like, oh, what I'd want today is just everybody to listen to me and do that. But then other days, like, you know what? I'm really glad they didn't, because like, it can be whiplash, and I can get the entrepreneur and just the turn left, turn right, do this, do that. I read this awesome book called Traction. Okay. Then I read this book. Now go do that. And it's like, all right, my team's like, where are we? Where are we at?
Yeah. That's funny, dude. Very similar, dude. Very similar. So what's the latest shiny object then? You said you're starting a business. What are you doing?
So we are going to SaaSify our home equity partner model. So the idea with home equity partners, we find the tenant buyers, we'll get it under contract, and it's like a white glove, you know, we're going to make a 10 to 20 grand assignment fee kind of on each deal, or we just have a great cash flowing asset. And I was like, but in order to do that, I have to charge 5 grand on a $400,000 house. And I don't really like that. In a perfect world, I want some family office that can buy that $400,000 home all cash, charge $3,500 a month in rent, and both sides be okay. There's not enough room for me in it to be hand-holding, get it under contract, underwrite, assign it, manage it, get it to closing. But if I was able to just be like, you know what? Chris wants a home. Turns out, you know, Jill has money. Can I just make a connection? And so we got some state of North Dakota dollars to actually launch this thing, which would be, we're not quite sure exactly what it's going to be, but it's essentially, instead of us playing telephone operator, which is a little bit what we're doing now, right? We're basically handhold, we find a deal, we get the asset, we're going through it. It'd be more so of a, hey, here's 1,000 people that all said, here's my credit profile, here's how much I want to pay in rent, here's my purchase price. And then you get investors where we just say, hey, give me 4 numbers, like, where do you want to buy? What's your cash on cash ROI? How much capital do you have? And what sort of lending, you know, underlying debt financing can you get? Is it conventional, commercial? You're doing it all cash. And then we're building up a software that literally matches people then. And then you can just start having a conversation, which is like, hey, do you literally want to buy me a house? Whether it's a rent to own, a contract for deed, or seller financing. And so we'll see if it takes off, but it was kind of fun. We got some grant dollars to at least test that idea and hopefully be an industry disruptor. But it turns out an idea is great. It all comes down to the execution and persistence. So that's the latest shiny ball, but there's been about 9 other ones that were like, yeah, we really shouldn't be doing that. So this is the one shiny ball that's actually, you know, getting more of Adam's attention. But for every one of those, there's about 9 other ideas
that you've got floating around. Yeah, it's hard to stay focused sometimes, especially when you have all these things going. But yeah, if you have the team, man, that's fantastic that you can do that. So how did you get the grant? Like, what was that process like? And was it, we have a thing here, like the startup week, you know, where you can go pitch an idea and do something like that. Is it very similar to that, or what would you guys have?
I was surprisingly shocked at North Dakota. You know, we got a little bit of oil money, so they started some different funds, but like, it's crazy what local like sponsorships are available, like whether it's the SBA, whether it's the Small Business Development Committee, whether it's the Chamber of Commerce, or it's the Economic Development Committee. Like, there's literally all these free resources for entrepreneurs and small business owners that, like, you kind of hear about it and like their government or their business. So it's like, it's kind of clunky and it's a little bit inefficient, but it's like, oh, they got SCORE mentors, where it's just like, oh, you have a bunch of like 50 to 70-year-olds who have done a bunch of stuff. They're just going to mentor me for free. Like, oh, I didn't even know that existed until like somebody told me about it. So it was like, I didn't even know this existed. They say, yeah, can you build a business that brings money into North Dakota that's software based? And they're like, I was like, I don't know, this sounds like a good one. So if they'll give me some free cash to do it, I'm certainly willing to do it. And I was like, okay, well then once they do that, then they're like, oh, we have an angel match program. So for every angel investor that you get, we'll match it dollar for dollar up to $250,000. And I was like, ooh, so then like my brain's like, oh, if they got all these incentive programs to trying to bring money into North Dakota versus just because some businesses just want to, you know, vitalize, like have more spending local, do all this, but like North Dakota's like, we're getting everyone leaving. We had a population of 700,000 people, which is probably like a quarter mile just circle around you. So like your entire city, you know, a quarter of your city is our entire state. So like, okay, how do we get more revenue coming in North Dakota? It's like, okay, well, can we be some little mini version of Silicon Valley here in Fargo, North Dakota? And so they started like a little ecosystem. So it's been kind of cool where they got like the Wonder Fund, which is I forget one of the Shark Takes, Mr. Wonderful, where he's like, like I'm starting this. So they have all like these incentives to now try to get startup programs. And like Oklahoma has one. And, you know, I'm not familiar with like Texas, but like there's all these different like accelerator grant and other things. I was like, turns out if it's who you talk to and like, oh yeah, you should totally try this. And like, I think about just like, oh, like if someone said, hey, do this and we can do that. I was like, well, why wouldn't I just try to go to the least path of resistance as opposed to just trying to do my own thing? So it's like, if I can get some free capital to test out an idea, I was like, man, that's kind of fun. Even though it costs my time, I'm like, this is kind of cool because it's like incentivized with the state. So you have a little bit of backwind to you and you can, you know, put that as a testimonial. You can, you know, use that as a leverage point of, you know, opening up things. Cause it's like, it's kind of a cool thing. Like, even if it was $1, if I was like, hey, the state literally paid me to start this business, I was like, that's just kind of a cool thing to say.
For sure, man.
Yeah.
Yeah, that's awesome. And so what you're building out is basically a platform. You're gonna, and how do you monetize a platform? You're gonna charge for someone to list their property, or you're gonna charge a monthly fee? Like, what's the thought process there, high level?
Yeah, the initial idea is that each would just pay like a monthly subscription of, call it $49 a month, for the opportunity to be connected with investors, and the investor to be, you know, connected to deals. There's other options of like, if it's similar to like Zillow, where it's like, oh, we have real estate agents, because like on every transaction, there's got to be a real estate agent. And so it's
Yeah.
like, oh, would we ever be, a friend to like the Zillows? Cause that's, their main revenue source. So there's been a couple of those. And then if there's, we can charge like a success fee for like matching without getting into securities issues. At least that's what we're currently told. So it's like, oh, could we, in addition to a membership, it's like, hey, if there's actually successful matches, can we have different tiers? And then if some investors want us to like hold their hand, is there different like premium packages, almost like a base, high and then above? And then selfishly, I was like, oh, well, we can just start creating syndications as well and actually participating as the investors. So if we just own all of the tenant buyers, if they can get literally like the lowest pricing of anything compared to like the competitors, and it has even the high risk, high, reward type, call it like sub mortgage type rent to own things. If we can just build out all of those investor profiles, we can kind of start handing out the same equivalent of the rent to own pre-approvals. And then there might be some version of like the equivalent of a loan officer. So I kind of want networkers. So I was like, hey, you know what? At least not in the software model, but like this is a standing offer to anyone. If you bring me a rent to own tenant, I'll give you $1,000.
Yeah.
And because it's like, I'm already paying Google $1,000 to get that same lead. So if someone just like send 2 emails, send one to your favorite real estate agent and say, hey, do you have any clients that can't get a bank loan? And then you send it to a loan officer and you say, hey, have you denied anyone that you think is pretty close to a loan officer? And if they're able to give you a list, or you're able to get that, and they're able to come through our program and we end up approving them and buying a home, like I would be happy to pay that, similar to like an agent would be happy to take a referral fee for 25% if they just get a brand new, buyer's contract or a listing agent or something like that. So that's always a fun standing offer, just to be like, all right, how do we get the word out to more people? Because we want to help more people too.
Man, you got a lot of stuff going on. I love it. I love it. It's so you have 5 different LLCs. Is that what you're saying? What is getting the majority of your attention right now?
So Home Equity Partners number 1, but then we have like various real estate holding companies that own real estate. Then I have a company that will fund flips, not as a debt position, but as an equity. So literally we'll fund it. They find the deal, we'll fund it, and then we split profits 50-50, like a joint venture. So that's another little business. And then we got the matchmaking one. That's another one. So those are kind of the main. They're all centered around real estate, but it's trending more towards the rent to own space, which is just like the domain that we just have a lot of industry knowledge on.
Yeah. And I want to ask you then about the hard money, like partnership type deal. So
yeah, let's do it.
Have you run the numbers on if you were just doing like 10 and 3 or 12 and 3 or whatever it is, like 12% with 3 points compared to what you're doing now? Are you far and away exceeding the returns doing a 50-50 split?
It is if the deal goes right, which is always like, some version of some risk. And so what we do is if it meets the 70% rule, I'll fund it and we'll split it 50-50. And what I found is, assuming that we can get in and out of a deal in 6 months, that's roughly a 30% annualized ROI. Okay. And so equivalent to the 10 and 3, depending on what volume and how many reps you can do, you can kind of get that same thing, or doing it similar. But with this one, it's a little bit more work. It's a little bit more reps. Cause I always say, similar to those, not to the tenant buyers, but to the flippers out there, like some of them don't have the 10 or 20% that the hard money lenders want. And for us, I was like, that's kind of our value proposition, is like, I'll literally fund the thing 100%, but it's got to meet the 70% rule and it's got to be legit. Cause I was like, people are killing for those. So like the wholesalers are different ones will come and approach us if they're like, yeah, I literally have already done some deals, but I'm tapped out on capital, but I have, these smoking deals. I was like, if you have the deal, if you're local, you have the contractors, you just don't have the velocity of capital. I was like, I got that. I got the velocity of capital. Like if you want 100 grand, 200 grand, 300 grand, and then if I have to get underlying debt financing myself, if I don't want to do the cash myself, I just like playing that game and betting on that. And if it sucks, if I have a joint venture partner that doesn't have the contractors or doesn't follow through, eventually I have to take it over. But it's it's literally my money. I mean, most of the time I want them to have like the earnest money or inspection or something, like, so they're literally not like walking into it with $0, but pretty darn close to 100%.
Yeah. That's I guess the biggest difference. I always look at the hard money side of it is, if you are in that position, you're getting deal flow like nonstop, right? Which is awesome. And then if they are putting anything down, even if they put like 10% down of the purchase price or something, then you're even more in the money from what they're buying it at if they mess it up or whatever. But you're financing, you're doing 100%, splitting 50-50, doing like a true partnership. Yeah. It's awesome, man.
Yeah, because it's more lucrative to them if they just got debt financing, because then they get 100% of the profits, assuming that it actually is a pretty good deal. So it's probably less. It's a higher ROI, I guess you could say, because they're not putting any money in, but it's a lower overall profit. So if people can use their own debt financing, like I actually say, like, hey, that's probably a better option for you. It's just for people that want to preserve some capital or use it for something else.
Yeah, for sure, man. You got a lot of stuff going on. Love it, man. It's like, it's always invigorating for me to have these conversations because I can see what you're working on, and I'm like, all right, I dig it. I like the platform idea too. We had a deal a while back at Geekdom, is like a startup place here in San Antonio, and you go in, it's like you pitch, and then they pick a few people, and then businesses actually are coming out of this thing. So it's very cool to see that, and so that and the fact that you've gone down that road and you have the capital and you're working on that, is pretty exciting, man.
And it's funny because like it definitely didn't start there. So yeah, 10 years ago I had one investment property. Like one, and it was like I was a civil engineer. I was sitting at my desk, but like my foot was tapping, and I was like, man, I gotta do some day trading or fantasy sports betting or some, start my own business, because like this, I'm going nuts. Like engineering has, kind of checks the boxes, and it was good income, but I was like, man, this is like killing brain cells. Like I got to do something else that has like a quicker return on investment. So then when I got like hooked on Bigger Pockets or the Fire or different things, it's like, man, I just got to do this. But the one thing I was always like pretty good at, it was like the taking action and then being like, all right, this is like a calculated reward to risk. And I was always trying to use the Tony Robbins, like disproportionate reward to risk. So I was like, yeah, heads, I make money. Tails, I either break even or I learn something, incredibly valuable. Cause I think a lot of people just get stuck in either the zero or it's tough to scale. Cause like, man, nothing really works. And so I guess I'm more willing to take on risk. And so that's why I probably surround myself with people that are, can kind of complement that. Cause I've definitely gotten into trouble, but it's like that was the mentality. Like, it was just like every day, just kind of feeding the mind with, Bigger Pockets and different things. But I think the quickest one, it was when Tim Ferriss was like, yeah, you could spend like 30 grand on an MBA, or you could go like buy a piece of property. And even if you lost the 30K, like, do you think that's better than an MBA? And I was like, oh, that kind of a light switch went off in my head. It was like, you know what? Why not use the capital instead of going for an MBA and like actually build a business, buy an investment property? And it's like, oh man, the hard knocks of what to do and what not to do was by far, way better than, reading spreadsheets and other things. And some people, it can work the other way, but I remember that being a pretty powerful motivator for me of like how to use the capital and invest instead of into education, literally into just like a business or a piece of property, and then do it myself.
Yeah, man. The action, learning from experience, I think is key. That is like one of the biggest takeaways. So look, man, I've thoroughly enjoyed our conversation. I love what you're working on. I'm going to throw your info in the show notes. So if anybody's looking, or if anybody has any rent-to-own borrowers that you want to throw Adam's way, by all means, reach out to him directly, and he's going to throw you some money. So yeah, thanks again, man, for jumping on, sharing your knowledge, information about your business. Good catching up.
Yeah, this was awesome, Randall. Thanks for asking the good questions. And it's always fun to talk with another dad that has young kids and kind of gets it, where it's like, man, like there's a lot of stuff going on. And for me, it's like, okay, what can real estate really do for me from hey, I'm working virtually in my home. Right after this, we're going to my kid's graduation. I was like, you know what? Some people have that flexibility in their job, but I was like, it's pretty true that with, I had a 10 to 15 year plan, and it was like, it just buy 2 homes a year for 10 years. And I was like, if I can do that, man, wouldn't that be something? But it's like,
next door, baby.
Yeah, that's right. And it's like, oh, if you just start off with that plan, like, man, you get the 1, 2, like your level of learning is just like crazy. So it's just kind of fun to look back.
Yeah. And for sure, we didn't really touch on that. I know you do some coaching and talk to dads. Is this correct?
I do. It's not the primary focus. It's mostly one-off, but like in groups like Front Row Dads and the Dad's Edge. So like nothing that I'm affiliated with, like I'm a participant in them. So like I'm a big fan of masterminds. I do coaching on the side, for some dads that have young kids that kind of want to get into real estate. Cause I was like, oh, I can uniquely talk to that. Whereas like I can buy a piece of real estate easier than I can get my toddler to get out the door in the morning. And so it's like having both of those conversation and using Chris Voss's techniques on a 4-year-old and like doing some mirroring and imaging. So, but yeah, it's mostly the investments, and just excited for what people can do when they actually get, some free time. Cause once you do that, it's amazing what people can do. And so I just want to share that.
For sure, man. Again, love it. Love what you're working on, man. It's good catching up. Again, if you want to reach out to Adam, just click through the show notes and you will be in touch with him directly. So thanks again, man. Good catching up.
Take care.
Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.